Welcome back, and in this lesson, we will review the deal premiums in mergers and acquisitions transactions. What we've got on this slide is the average premiums in mergers and acquisitions transactions that happened worldwide in the years 2017 and 2018. You can see the deal premiums across different industries, and these premiums are based on the share price 4 weeks prior to the announcement of the transactions. So, on average, you can see that the deal premiums range between 14 and 40%, depending on the industry. And the question is, why does a premium have to be paid to the target shareholders if the market value of the target already takes into account the cash flow growth and risk profile of the target and it's fairly valued? And there are multiple reasons for the willingness of the acquirer to pay the deal premiums to the target's shareholders, some of which we've already discussed, such as synergies. So, if the acquirer believes that he will be able to combine two companies and increase the revenue of the combined entity, or reduce operating costs, or both, then it makes sense for the acquirer to pay more than the current standalone value of the target. Other reasons include, for example, the competition among the bidders for the target. If there are a number of acquirers who want to buy a specific target, then they will be bidding up the price for that target. Inflated valuations or distressed valuations can also drive up the price for the target. For example, if the target is in distress, then its market value will be low, and if the acquirer believes that he can turn around the distressed situation of the target, then it makes sense for the acquirer to pay a little bit more than the target's standalone value. The availability of cheap financing is another reason why acquirers offer premiums to the target's shareholders. When cheap financing is available, the acquirer can use substantial leverage in financing the purchase price of the target, and the leverage will generate value. In special situations such as hostile takeovers, the acquirer will have to offer a premium over the market price of the stock to the target shareholders if he wants to persuade the target shareholders to follow along with the proposal of the acquirer. So, these are some of the main reasons why the premiums exist in mergers and acquisitions transactions, and they all lead to one key concept in mergers and acquisitions theory called control premium. When an individual investor buys the shares of a listed company on the stock exchange, he pays the price, which represents the value of the minority stake. However, when he wants to buy the whole company, he will have to offer more than the value of the minority stake, because we will be taking control of the company and we have to incentivize the shareholders of the target to sell their ownership in the target to us. Since we're taking control of the company, the premium that we pay is called the control premium, which ranges, as we saw in the previous chart, between 15 and 50%, depending on the market, industry, country, and etc. So, the value of the minority stake plus the control premium represents the deal price for the controlling stake. If the acquirer only offers the price of the minority stake, then it's unlikely that the acquirer will be able to acquire the controlling stake in the target. Therefore, the premium has to be offered to incentivize the shareholders to sell their ownership in the target. The next question is, how do we come up with how much premium we have to pay to the target's shareholders? And the answer consists of two parts. The first part comes from the financial model, which is built to analyze an M&A transaction. And the financial model has to show us how much premium makes sense to offer to the target. Usually, the premium analysis, which comes from the financial model, is supported by the premium paid analysis performed by financial advisors. In the premium paid analysis, we look at the M&A transactions that include comparable companies. We calculate the average premium paid in those transactions based on the share price 1, 7, 30, or 90 days prior to the deal's announcement. And this share price is called unaffected share price. So once we have the average premiums paid in comparable transactions, we then look at the offer price and calculate the premium embedded in the offer price. In this table, we've got the hypothetical example of a company called ABB, which is being acquired. We've got the share price of the ABB and embedded premium in the offer price based on the unaffected share price. We can then compare the premium offered to the average premium paid in comparable transactions and figure out whether it makes sense to accept the offer or not. So, if we're on the acquirer side, then we can use the premium paid analysis to see if the premium suggested by the financial model makes sense. In this way, we can use the premium paid analysis to support our negotiations with the target.